Hello and welcome to CNQ.TO Investment. This analysis is for Canadian natural resources on the Toronto Stock Exchange as of 27th of July 2026, with a share price of 63 Canadian dollars 26. The full report is on CNQ.TO. Gans is arten aus die go. A hold at 63 Canadian dollars and 26 cents on the short term, the stock is overbought after an oil-driven run and the Iran-Hormuz premium is unwinding, but Canadian Natural is a low-cost cash machine that's cheap on cash flow, and the medium and long calls are both buy. Accumulate on a pullback. Canadian Natural earns a return on equity near 23%, best in class for a large oil producer, and it produces barrels at a corporate break-even around $40 against oil near 82. That gap is the whole story. It keeps gushing free cash flow deep into a downturn when higher-cost rivals stall. Net debt is only about 1 times cash flow. The payout is a sustainable 46%, and the dividend has grown for more than 25 straight years. Quality scores 80 out of 100. On a strip-normalized basis, it trades around 6.5 times cash flow against an 8 times line we'd call rich for the sector, so it is genuinely attractive, not expensive. Forward earnings multiple is about 12.3, comfortably under a 15 times ceiling, and analysts see roughly 70 Canadian dollars, about 11% above today. The one caveat is the free cash flow yield, near 4% after the recent run, fair rather than a bargain. Reported profit is flattered by a one-off gain, so we score on the cleaner forward numbers. Valuation scores 67. This is where the short-term hold comes from. The daily chart is overbought, relative strength index around 71 after a run to $66, and the oil premium that drove that run is unwinding on the Iran de-escalation, so the stock fell about 3% today. The longer-term uptrend is intact, and the driver still scores a neutral 58, but chasing here is poor risk-reward. The better entry is a pullback into the $59 to $61 shelf, and second quarter results land on the 6th of August, a genuine near-term event. The risks are mostly one thing wearing several hats: oil. A full Iran stand-down could pull crude to the low 60s, which is where the bear case near $52, about 18% below today, lives. Second quarter results on the 6th of August are a binary near-term event, and heavy oil price differentials and Canadian carbon costs can quietly eat into margins. None of this threatens solvency at a $40 break-even, but it is why the near-term call is hold, not buy. Now weigh the risk against the reward. The bull case is roughly 23% above today, the base case the most likely about 7%, and the bear case a fall of about 18%. So you are risking about 18 to make 23. So, our call on Canadian Natural Resources, on the Toronto Stock Exchange, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by CNQ.TO Investment at CNQ.TO. The link to the full report is in the notes below. Have a great day.